welcome to another edition of the MDM podcast. I'm Mike Hockett, MDM's executive editor. This episode focuses on a company that's making some major waves in the HVACR distribution market, Quebec, Canada-based The Master Group, which began operating in 1952 but has grown rapidly in recent years behind the backing of private equity partner Novacap. In the past 2 years, the Master Group has made 2 acquisitions in the US that gained it nearly 30 branch locations, and the company says its vision is to become the leading HVACR distributor in North America. The Master Group president Neil McDougall joined me to discuss the distributor's recent growth and expansion roadmap, as well as how product demand and the labor situation compares between Canada and the US. Enjoy. All right. Well, Neil, thank you for taking the time to join the MDM podcast.
Thank you, Mike. It's great to be here.
All right. Well, to begin with, can you give our audience a brief description of the Master Group and its capabilities?
Yeah, in a nutshell, the Master Group is a 71-year-old HVACR distributor. The company is headquartered in Montreal in Canada. We operate 56 branches in Canada and 5 distribution centers, and we also operate 29 branches in the US. We're really focused on direct sales to licensed contractors in the heating, ventilation, air conditioning, and refrigeration space.
I want to dive in here with the news of the Master Group's acquisition of Valley View, Ohio-based refrigeration sales company, or RSC, which is an independent HVACR distributor founded in 1945 that serves Ohio and the Western Pennsylvania region from 10 locations. That deal marked the Master Group's second acquisition in the U.S., following its late 2021 purchase of Richmond, Virginia-based value-added distributors. And that deal added 19 branches across 6 states. So together, that's a major U.S. footprint gained for the Master Group in less than 15 months. Can you share just how exciting this past year and a half has been for the Master Group to be expanding so fast in the U.S.?
Yeah, Mike, to be honest, it's been tremendously exciting, tiring, absolutely as well. But yeah, tremendously exciting. I mean, the U.S. footprint for us now with this recent acquisition of RSC takes our U.S. business to 35% of our overall portfolio. And that's happened, again, very, very quickly. Was all part of the plan. We're coast to coast in Canada now. We expanded into Western Canada about 4 years ago, which was a market we were not in. That really took us coast to coast. And the next natural step really was for us to move into the US and build a sizable footprint in the US market too. So yeah, tremendously exciting. We've grown very, very, very quickly over the last several years. It's a lot of fun.
Sure. And in the press release for that latest news, CEO Louis St. Laurent stated that, quote, "Our vision is to become the leading HVACR distributor in North America," end quote. And to do so, I assume that there will have to be more expansion involved. Can you touch a little more on that overall vision and if there's a roadmap for that U.S. expansion plan?
Yeah, look, there's absolutely a roadmap. I'm not going to share it in all its detail with you today, Mike, but realistically, it's built out of a couple of key elements. The first of those is continued organic growth, which has really been the foundation of Master. We have continued to open new locations more aggressively than arguably anybody else in our industry. And we strongly believe that being close physically to where our customers do business or where they're going to be doing business in the future is really critical to our success. There's no doubt that e-commerce and investment in technology and different tools are going to be important for contractors, but foundationally, just physically being where your customers are or where they're going to be is really at the heart of our growth plan. And then the second part of that is through acquisition and continuing to expand our footprint strategically, where it makes sense, both geographically. And then I'd say also in terms of adding core capabilities with some of those partner companies that we've been able to acquire.
So we can definitely expect to hear more news out of the Master Group in the years ahead. We'll keep an eye out for that. Looking at RSC and Value Add these past 2 years with these 2 acquisitions, what were the attributes about those 2 companies that made them particularly attractive for the Master Group to pursue?
Two things probably, Mike. First one of those is really a strong existing foundation. Really it's much easier to invest and try and grow a company that has got a strong foundation itself, both operationally, but also needs an investment of capital to grow in certain areas. Again, tools, technology, additional footprint, etc. And then secondly, but by no means second in the ranking, is really the values and foundation of how that company operates. What it stands for. Really its connection to its customers and to its team members really are the backbone of Master, and we very much look to partner with companies that doing business the right way, supporting their local communities, and also taking care of their people.
Anything else you can share about what is on the Master Group's checklist when it comes to evaluating an acquisition target?
I would say, honestly, not really. I mean, we like to try and kind of keep it simple, right? It's, let's have a focus on taking care of our customers, being easy to do business with, helping our customers grow, and really investing in their future. If they win, we win. We really try not to make it any more difficult than that, to be honest.
I think there can be a tendency to overcomplicate things, and it seems like companies know what they're looking for. They know what a good fit looks like. I think that advice of just keeping it simple is probably the best there is.
If you look at industrial products distribution across North America, call it that, the vast majority of those distributors started as family businesses, and at some point, those family businesses really need to switch gear to invest aggressively in their business in order. I don't want to use the word relevant, but there is an element of staying relevant in your industry. Yeah. And scale is really important to that. If you've got to invest in the type of operational infrastructure that you need to today in the HVACR market, we just had an efficiency change January 1st for equipment. We have a refrigerant change coming in 2025, which means refrigerants will be slightly flammable now. So handling those products from a material handling perspective in your distribution centers and your branches, investing in training for your contractors, all of that takes a lot of investment, and that's becoming increasingly more difficult for smaller distributors. And that's arguably why you've seen, I would say, such a fervent acquisition market over the last few years in industrial products distribution, and that's going to continue.
Certainly. The RSC acquisition press release noted the Master Group's commitment to the North American HVACR expansion after securing significant growth capital from long-term private equity partner NovaCap. So I do want to give you a chance to say some nice things about NovaCap, and how has that relationship with NovaCap prospered, and what do you think that it sees in the Master Group that encouraged its financial backing?
I think the relationship is a tremendous one. It dates back to 2014. So NovaCap has been involved with Master for more than 8 years now, and it's a pretty long time when you consider it from a private equity standpoint. And I've also, as obviously we've communicated, I've recommitted for several more years to support the growth of Master. And you really only have to look at the history of Master, that is now nearly probably six times the size it was those 8 years ago. That'll give them all the smiles that they need as to why they should continue to be involved in Master. I mean, they have backed us, they have supported us, they let us run our business, they let us invest in the right things, and it's a great match, and they really are a great partner, both historically and for the future, and we're really pleased with the association.
And like we touched on, it's definitely led to some exciting times over those just that 8-year span, especially in the last 15 months here. The Master Group is a member of Heating, Air Conditioning, and Refrigeration Distributors International, or better known as HARDI. Same thing, I want to give you a chance to shout out to HARDI what value that membership has been to the Master Group and how it has helped the Master Group expand, especially in the U.S. market.
Yeah, I mean, look, membership to HARDI, first and foremost, is really about staying connected to our industry, but also staying connected to owners and leaders across our industry, and making sure that we invest and ensure that our channel as independent distributors remains strong, and also evolves as our customers evolve. Now certainly building a network of owners and leaders as contacts across the industry certainly supports part of our agenda, which is to partner and acquire and then grow. And Hardy provides a great platform for that. But as I said, first and foremost, it's really about us staying connected to and really playing our role as one of the larger independent distributors in North America, playing our role to make sure that we drive the right things for our industry to ensure that we are all successful.
Out of any association, that seems to be their biggest value add offering is just that network reach that you get across the industry, like you said. And it's just great to see that you guys are leveraging that there at the Master Group. I want to quickly touch on labor, which, a lot of talk in distribution about just how challenging the labor situation is out there. So I want to get your perspective on how the Master Group is doing on the labor front. And MDM has covered extensively how, US-based distributors have had major challenges on both the recruiting and retainment of talent, especially over these last 2 years and in the warehouse. But with the Master Group being a Canadian-based company, I want to ask, have those labor challenges been just as potent, or is it a really different world? Are there any recent initiatives that the Master Group has done on the talent recruitment or retention front? So just trying to get your perspective on how the Master Group is handling the labor front.
Yeah, it's a great question. I think it's very similar from what I see, very similar in Canada as it is in the US. It's tough to get good talent. It's tough to retain good talent. It's particularly difficult, I would say, at the lower end of salary ranges. So those folks that work in our distribution centers or drivers, etc. Where hourly paid workers are being offered a dime or a quarter or whatever it is, and it makes a difference. But there's been so much of that's been going on that there's no doubt it's challenging. And I don't know certainly that we have a silver bullet. I think what I would say, and this probably is a byproduct of everything we've been doing over the last several years. It's not really an initiative, but Mike, people want to be part of a winning team, right? They want to be part of a company that's growing. They want to be part of a company that's successful, really. So it provides the safety and security for them from an employment standpoint, but also for them and their families. So, we really have a great story to tell because we are growing so quickly. And I love telling that story. It's really a lot of fun to be able to do that. It also provides great opportunities for our team members as we expand quickly for promotion opportunities to move around the country in Canada, should they wish to, and potentially in the US as well. That type of environment creates opportunities for people moving up in the organization, and it actually creates opportunities lower in the organization for backfill and recruiting, which tend to be easier to fill. So we've kind of created some of our own momentum, but again, I wouldn't say we did that on purpose. It's a byproduct of how quickly we're growing, how quickly we're opening new locations and expanding.
It makes sense. And yeah, for any company that's experiencing rapid growth like the Master Group, I have to assume that there are a lot of roles to fill as that company grows. But like you said, I think that company's growth, it does kind of speak for itself as a sales pitch to potential employees out there. So like you said, I think it's all about that momentum and letting potential sources know that. I also want to touch on product demand in the HVACR industry compared to the US. And for the past year, at least, it seems like we've been hearing about this pending economic or industrial slowdown that, is on the horizon. But through late March here, it seems like distributors can keep telling us here at MDM that industrial demand is still strong. Their numbers aren't showing signs of a slowdown out there. Their backlog of orders is still strong, and supply chain conditions continue to improve. So we are hearing a lot of optimism out there, and it looks like this, pending slowdown might be pushing further out. So with that, I want to see, what is the Master Group seeing or hearing out there in terms of HVACR demand and the 2023 near-term outlook, at least? And is there any major differences in demand from Canadian customers versus US customers?
I don't think there's really any difference between the Canadian customers and the US customers. I mean, our business in Canada is a little more diversified into hydronics and deeply into refrigeration. Those markets remain very buoyant. Certainly the commercial and industrial markets remain very buoyant as well from a backlog standpoint. There's a lot of projects that will now take the next 2, 3, 4 years to complete. That business is very, very strong. Backlogs are as strong as they've ever been. I think where there's still some uncertainty is in the residential markets. And we're an industry that's driven by extremes of weather, right? So when we start to get those extremes of weather, coming up here in the summer is when we'll really know, I think, what the demand profile is going to look like for the next several months. I mean, all of the manufacturers in our industry are still pointing to a slowdown in unit sales year over year through the back end of this year. Mm-hmm. But again, you get a blisteringly hot summer, it'll be great. It'll be great for everyone, and everybody will need to sell through their inventories, which are quite high right now, just given the supply chain challenges of the last couple of years. So I think everybody would like that. But yeah, I think commercial, industrial, great, strong backlogs. Lots of projects are still happening. New backlog is being created too, so it's not as if there's just lots of backlog out there that's going to take years to come. There's new projects coming. Residential is really, I think, a bit of a wait and see for everybody. But we certainly, and everybody I speak to in the industry, are expecting it to be flat at best from a unit sale perspective. I think that the financials might look a little better, as pricing still continues to roll through the industry. And, this recent efficiency change we had in January has increased the cost of equipment, as a step change anyway. So it's not going to be about the dollars. It's going to be about how many more units did we sell. At this point, nobody's expecting that to go up year over year.
Definitely. And yeah, I think I would expect to hear that same sentiment from distributors in almost every industrial market, whether it's MRO, whether it's plumbing, whether it's electrical, and certainly with HVACR. So no surprises there. Well, that's really all the planned questions I had for you here, Neil. Is there anything else about the Master Group that you think our audience of distribution executives should know that they don't know already?
Boy, that's somewhat of a loaded question. I'm not sure I'm best placed to try and tell anyone else how to run their business. But look, I'd say, we've done a really good job just trying to stay focused and try and keep it simple. Okay. And trying not to overcomplicate that. At the end of every question, there's a customer, right? Customers need to grow. They grow, you grow. Make yourself easy to do business with, evolve as technology evolves, because the contractor of today does not look like the contractor of yesterday and will surely not look like the contractor of tomorrow. And as a distributor, your job, you buy things, you put them somewhere, you move them somewhere else, and then you sell them. It's not that complicated, so let's not make it that complicated. But we've got to make sure there's value in that channel, and that's really by connecting manufacturers to contractors and providing the best value we possibly can in products, service, training, other educational resources, and then also support after the sale. That's why they need us, and that's what we stay focused on.
That's a great spot to end this with. Well, Neil, thank you for taking time again to join the MDM podcast, and thanks for the time here.
Absolutely. It was a pleasure. Thanks a lot, Mike.